Wow, LA, yeah. LA is just I like LA. It's just the traffic. And you talk to an LA native and they go, "Oh, it's easy. You just take the 5 to the 210 to the 710 and then cross over to." I'm like, "No,
Yeah,
no."
that 30 miles is only 2.5 hours.
Yeah, they gauge distance by time.
Yeah.
Like six miles to get to downtown LA, and like, "Oh, okay, it's only 6 miles, and what's that, 6 minutes?" He goes, "No, more like 30 to 40." I'm like,
Yeah.
"What?" Crazy.
And it's
Nice
just,
place,
it,
but
it's getting the same way here going over the hill to the Bay Area, the 205 and the 580.
oh yeah,
Uh,
yeah, yeah, yeah.
and,
With all the shelter in place, going out there. I mean, I had to go out there to Dublin, and I was coming back like around 3 o'clock, and no traffic, but now there is. Hey, John.
Hey guys, I
Sorry.
hate to interrupt you reminiscing about the good old days in LA,
well,
but
it's nice for you to show up.
hey, I'm here right on. I've been here. I've been listening. Anyway, let's go ahead and get started. So first and foremost, thank you everybody for showing up. I appreciate you all being here on a regular basis. As a reminder, any questions you have about anything, please post into the chat. If you're watching live on Zoom, if you're on Facebook watching this, then I'll get to you later. But feel free to post those questions there. So I want to go ahead and get started. First and foremost, Jeff is here from Chicago Title. Jeff, do you have any updates for us about the title and escrow world?
I wish I had something exciting to talk about, but I really don't.
All right. Well, just do what I do. I make it up every week. If I have nothing to say, I come up with something new. So hopefully this is, as I've said always, I'm repeating the same information I covered on Monday. Today is a little bit different because there's a couple of pretty major things that came out over the last couple of days. And so some of you may have joined on Monday, and I've got you coming back today. So I'll tell you when it's time to go, when I'm going to repeat the stuff that I talked about on Monday. But let's go ahead and dive right in. So first and foremost, what are we going to cover? Rate update like we always cover. So this part's going to be a repeat. Forbearance updates. That's a big one. There's a big change to forbearance that I need you to be aware of and that you're going to want to be aware of. And so I'll be covering that in depth. The next thing that we're going to cover is some good news about loan guidelines. So all you guys keep hearing from me every single week is bad news about, hey, guidelines are tightening, guidelines are tightening. We finally have some good news that loan guidelines are relaxing. I specifically call it overlays because Fannie and Freddie never tightened their guidelines. FHA and VA never tightened their guidelines. Lenders did. They restricted those rules. We're starting to see some relaxation of those restrictions, specifically what Summit Funding has done, and I'll cover that. We're going to talk about how to write the winning offer. So that is the same content I provided on Monday. If you were here on Monday and you want to hear it again, stick around. If you weren't here on Monday, you can disappear at that point, and I'll let you know when that happens. And then I'll talk about my upcoming webinars, and I'll get you all out of here. So let's go ahead and get started. First and foremost, interest rates, pretty much a broken record. Overall, we've been very stable for the last 30 days. They've moved up a little bit in the last week, but that's not a bad thing. That's healthy for the market to see a little bit of volatility, but it's minor volatility compared to this major volatility that we had back in March. That's super, super good for the mortgage market. I also think a lot of things we're going to talk about in forbearance will potentially calm down some of the concerns on lenders' side about some things, and I'll explain it in a minute, that very well could allow rates to fall a little bit lower. The other thing I mentioned to you guys a week or two ago is the door has been opened for 30-year fixed rates to go down by another 0.5%. And as a reminder, what that means is mortgages are traded in coupons, and once you hit the floor of a coupon, the lowest rate it can accept, you can't go any lower unless the next lower coupon, 0.5% lower, is what the increments of coupons are. And you can't go any lower if there's not another coupon to place that mortgage into. And the next lowest coupon started trading and pretty actively trading a few weeks ago. That's opened up the potential. It is not yet where the rates are at, but it opened up the potential that rates could move up to 0.5% lower than where they had been. That means we could theoretically see a 30-year fixed rate as low as 2.5%. That's absolute craziness, but it is the reality of what we could end up seeing. So our advice is still the same as what it was before. On a purchase, lock it as soon as you have the chance. On a refi, we think rates are going to continue to improve or stay pretty steady to where they are now. There's no point in paying for a long-term lock when you can get better rates by locking for a short period of time. All right, let's dive into the new information. So on Monday, I did update you guys. I talked about it a little bit last Wednesday, talked about it a lot more in depth on Monday. I'm going to go into depth again on the first part, the deferral program. So this part's not new news, but the second set of bullet points is very, very new news. It came out yesterday. So the deferral program is what Fannie Mae and Freddie Mac announced last week on Wednesday morning. And it answered the question of what happens after I go into forbearance and I now need to get out of forbearance. What's going to happen to my monthly payments? And there was a lot of speculation that we all had, including me, that said, well, maybe we're going to require a prepayment or a balloon payment that you have to pay the full amount that you skipped immediately. There was concern that, okay, maybe people who can prove a hardship, because remember, to file for forbearance, you did not need to have a hardship documented. You just had to state that you had a hardship or that you needed assistance with your mortgage payment, and you were automatically put into forbearance. What we found, though, is a lot of people were put into forbearance not actually wanting it. You've heard me tell the stories about people who just clicked the button online because they wanted information about forbearance, and they were not actually intending to request the forbearance. There's a solution for those people in a couple minutes. But what I'll tell you is that for people who went into forbearance, they didn't have to prove a hardship, and we were concerned what's going to happen when you're done with forbearance? What happens after the 3 or 6 or 12-month time frame? What about those skip payments? How are you going to make them up? Well, Fannie and Freddie made it super, super clear last week. You don't have to make them up now. You have the ability to place those payments that you skipped into a deferral, and you will pay them back when your mortgage is paid off in 30 years, when you refinance the mortgage, or when you sell the home. So you do not have to pay that money back at all. Or excuse me, that's a bad way to say it. You don't have to pay that money back right away. You have a significant amount of time, really until you're done paying off the mortgage. That's really, really good news for the people who needed a forbearance. Here's the double-edged sword. There is no requirement at the time you accept the deferral to prove that you had a hardship. Now, in a way, it's, hey, easy in, you can get a forbearance for easy, and it's easy out. Once you have the forbearance, then it's no big deal. You can just get out of it and postpone those payments until the end of your loan. No penalties, no interest, no nothing. And so I think that's probably the best of all of the alternatives that we had. But here's the truth. It's a significant concern for the moral hazard, or creates a moral hazard. And my concern is how many people are going to file forbearance because there's no negative. And as a matter of fact, there was only one negative left as of Monday when I told you guys about this, which the one negative left is, how long do you have to wait until you can buy a home? Well, as you see on the next bullet point, and I'll cover it in a minute, that waiting period went away, and I'll cover that in a second. But the bottom line is that with the deferral program, if somebody calls their servicer and says, hey, I can afford my payment again, I've got my job back, I'm good, then the servicer says, fine, we're going to resume your monthly payment. We're going to skip one more month so that we can process the paperwork. And so if you took off April, May, and June, then you talk to them in June or early July, and they say, great, we're still going to skip the July payment so we have enough time to process the paperwork, and your first payment is going to be due August 1st. That 4 months that they skipped is automatically put at the end of the mortgage, paid when they sell, refinance, or pay off the mortgage at the end of the term. If the person cannot afford the payment and they say, look, I'm still in trouble, then the bank is going to give them an extension of the forbearance period, up to 6 or even 12 months of a forbearance period that they'll get that extension. At the end of that time frame, if they still cannot afford their monthly payment, then the bank is going to do a modification. And Fannie Mae and Freddie Mac made it clear that that is a preferred alternative if someone is working but cannot afford the payment they used to be able to afford, to modify their mortgage and put them into a modification plan. All right, Kathleen asked a question. Guys, remember, you can post your questions onto the chat in Zoom. If you're watching on Facebook, I'll catch those questions later. She says, does it hurt you in obtaining a loan or a refi? I have a client who filed forbearance, but when she found out what it meant, she decided to keep making the payment. What happens with that? That's a perfect question, Kathleen. You read my mind because that's exactly the news that came out yesterday. So here's what came out yesterday. Fannie Mae and Freddie Mac said, now I need to be really, really clear about this distinction. Bullet point number 1, the deferral program is for people who currently have a Fannie Mae or Freddie Mac mortgage, and they went on forbearance. The next guideline, the next thing, new loans after forbearance, has to do not with who your forborn loan was with. Guys, I finally figured out how to say forbearance in past tense. So it has nothing to do with who your forborn loan was with. It has to do with what type of loan we're doing for you when you're trying to purchase or refinance. Don't misunderstand that, because the guidelines I'm about to talk about applies to a new loan with Fannie Mae or Freddie Mac. It has nothing to do with what type of loan you had in forbearance. Fannie Mae and Freddie Mac have clarified 2 very simple rules. The first one applies to what Kathleen said. Somebody applied for, enrolled in, got put in forbearance by their bank, and they didn't skip any payments. They continued to make their regular payment, and that happened to a lot of people for a lot of reasons, not the least of which is just inquiring about it, or maybe they were thinking they were going to do it until they found out the terms that they might have to pay it back as a balloon payment, and they said, forget it, I don't want to have to do that, and so they kept making their regular monthly payments. For those people, this new rule says they are able to purchase or refinance immediately with no waiting period. And the key is, as long as they didn't miss a payment. Now, anecdotally, I'll tell you that I've got some concerns because I know of at least one major bank that actually refused to process payments for somebody that was in forbearance. I have a client who tried to make his payment after, he did file for forbearance, but then he decided, oh, I don't want to actually be on forbearance, and he made his payment. And the bank rejected his payment and said, you have no mortgage payment due that we can apply this to. Now, he had to call 3 times and fight to get them to accept the payment. But I am a little bit concerned that some people who tried to make their payment and weren't paying attention, the bank rejected the payment, and they actually do fall under the second category of people who missed payments. But I'm sticking with the first bullet point. People in forbearance that didn't miss any payments, they can qualify to purchase or refinance a home immediately. Now, here's where I got to be careful. I got to be careful these are Fannie Mae and Freddie Mac's guidelines, but this is not necessarily the opinion of the individual bank that you are going to. Now, Summit Funding has not yet rendered our opinion. It's been 24 hours since these new guidelines just came out. There's a chance that we could say, well, hold on a second. If somebody filed forbearance and they also had a forbearance on their car loan and their credit cards and all the rest of this stuff, we're kind of worried, even if they did end up making their mortgage payment, maybe they only made it in order to get a refi, but they're gonna go ahead and forbear again once they get the new mortgage because they have that right. And as an institution, we're on the hook if somebody does a forbearance immediately after we do the new mortgage. There is a good chance that the banks are not going to just carte blanche say, hey, if you were in forbearance, as long as you meet these Fannie Mae rules, we are fine. So be careful in interpreting what I'm describing to you. It is not yet the rule that Summit Funding is interpreting, and I know that every other bank is interpreting right now as what we're willing to accept. We cannot be more relaxed than Fannie and Freddie. And I'll make that explanation, I'll make that example with the next bullet point having to do with if you did miss a payment. So if you filed forbearance and you did miss a payment, once you are back to making your regular payments and you've made 3 on-time payments, you are now approved or you're eligible to do a new conventional loan. So when I said the banks can't make the guidelines more relaxed, a bank cannot say, hey, I'll let you do a conventional loan 2 months after you've caught up your payments, because that would be more relaxed than what Fannie and Freddie are saying. But a bank could say, I'm not comfortable with 3 months. I still want to wait 6 months, or I still want to wait 9 months or a year. a bank has the right to make the rules more restrictive as long as they're applying it across the board. They can't apply it selectively. They have to apply it across the board. But just be aware of the fact that just because Fannie Mae and Freddie Mac said it's okay, we've got two different hands, two different hands here that are saying two different things. Because Fannie and Freddie are saying it's no problem, you can do a new mortgage, but they're also saying, hey, bank, mortgage bank, Summit Funding, if this guy does a new mortgage and they file forbearance right away, you're on the hook. You got to pay us anywhere from 5 to 7% of the face value of the mortgage as a penalty fee because you did a mortgage for them and they filed forbearance. Hopefully you can see the challenges here in the eyes of the mortgage bank because we have a significant cost that we are concerned that we have to eat, including cash out refinances. I've talked previously, and I'm going to cover in a couple minutes some changes on cash out refinances, but there is a huge risk on cash out refinances if somebody goes into forbearance right away after we do the mortgage. I would not be surprised if some banks add additional restrictions to cash out refinances for people that had previously filed for and or missed payments via forbearance. So guys, this is a lot of new information. Please post in chat if you have questions about it or need clarification. But again, we are clearly understanding Fannie and Freddie's rules. If you want a new conventional mortgage, you need to wait 3 months if you skipped any payments, and it's 3 months of on-time payments after you start making a payment again. Or if you never missed a payment but you filed forbearance, you have no waiting period whatsoever. To be clear, FHA and VA have not given any guidance yet on what happens if somebody wants a new FHA or VA loan and they had a previous forbearance on their mortgage. We find often that FHA and VA wait for Fannie and Freddie to make a decision and they follow suit. And so I don't think it's too far of a stretch to assume that's likely to happen, but y'all know what happens when you assume. So let's not go too far in assuming that. But the reality is that is my expectation that that FHA and VA will follow Fannie and Freddie's rules. Guys, here's the bottom line for me. This has removed all of the negative consequences to filing for forbearance. And if we were to speak bluntly and privately, it's not like I'm publishing this on Facebook right now or anything, haha. But the truth is there isn't any reason why anybody shouldn't file for forbearance. Well, except for the fact that the right thing to do is to meet your obligations that you agreed to pay, and except for the fact that it's going to create a huge fiscal burden on the banking industry, and that it could create major repercussions down the road to interest rates and market conditions. And so the problem is the individual consumer is less concerned about the overall health of the market. And that's what scares me the most about these things. I think we put ourselves in hot water by the way these rules were written. And the solutions are the best solutions that I think they could have come up with given the challenges that they created. But it really puts us in a major moral dilemma for a lot of homeowners and saying, well, then why in the world shouldn't I file for forbearance? Because I can take up to a year off of my monthly payment and I only have to wait 3 months after I start making my payment again in order to qualify for a mortgage. Mark, you said perhaps the last hurdle, hold on 1 second here. Perhaps last hurdle remaining is the potential overlay for particular lenders related to forbearance. That is an accurate statement, but the other side of that coin is there's always going to be some lender somewhere that's willing to do it without an overlay. And I don't think consumers are thinking in that regard. I think as a community, as business people in this community, we have to keep that in mind and share that concern to our borrowers that, hey, just because Fannie and Freddie said it's okay doesn't mean everybody's going to say it's okay. But it is definitely lowered the bar, lowered the barrier for people who are thinking about forbearance, and they didn't. And it really comes down to that person who, as a matter of fact, is what Kathleen said above. She had a client who filed forbearance, but when she found out what it meant, she decided to keep on making mortgage payments. Well, now she knows that it means that she doesn't have to pay it back for 30 years. So how many people are going to rethink that? Maybe they called 2 months ago and they found out, oh my gosh, I have to pay it back right away. I'm not going to do it. And now they've learned that they don't have to pay it back right away. And so maybe it's a better idea to go ahead and file forbearance. I think that's the challenge that we're up against. I don't think there's anything that you or I can do about it, but awareness. The reality is we'll have to see how it plays out, because these are the cards that we were dealt, and there's not a whole lot we can do about it. All right, I'm going to move on from this. Before I move on, any other questions, post it into chat on the forbearance issue. Otherwise, I'm going to move to the relaxation of overlays and some super good news on a few things that I'll know you'll want to be aware of. So let's go ahead and move on. All right, so a couple of overlays that have been reduced. I know there's probably some that you guys are hoping for that are not on this list. I'll tell you right away, there isn't a second page of this list, so don't look for something else that isn't here. But there's a second page of a reminder of the things that are still there. But here's the deal. Any relaxation of overlays means we've turned a corner. That doesn't mean we can't go backwards, but it means we've turned a corner, and that banks, specifically Summit Funding, are starting to feel more confident that stability is coming back into the market. And this is a really, really good thing. So what we're seeing right now, and this impacts you guys directly, is we're seeing cash out refinances that are now being more available than before. Now, I heard from Todd Screama, the owner of our company, last night, and he said Summit Funding is still one of the few mortgage bankers that are doing a sizable amount of cash out refinances. Remember, the issue with cash out is Fannie and Freddie said we own the loan. They will not buy it from us at all if somebody files forbearance before we sell the loan to Fannie Mae and Freddie Mac. What we said in reaction to that last month is that's fine, then we're not doing any cash out refinances for anybody except owner-occupied single-family residences. Today, we've relaxed that, and we said, okay, as long as you have an over 700 credit score, you can do the other 4 categories described here. So we can now do cash out on investment properties again. Have to have an over 700 credit score. We can now do cash out on second homes again. We can do cash out on 2 to 4 unit properties again. And we can do cash out on high balance loans again. So high balance is anything over $510,000. Sacramento area has high balance. The Bay Area does. The San Joaquin Valley does not. This is really, really, really good news. As a reminder, the 700 credit score only applies to these 4 items. So a owner-occupied single-family home, we can go below a 700 credit score for cash out. Now you guys are saying, John, why does cash out matter, or a real estate agent? How many people do you have that are buying homes and they use cash from their current home to pay for the next one? I have a client that was referred to me a couple of weeks ago that owns multiple investment properties, has a primary residence. He wanted to pull cash out of his primary residence to buy another investment property. We couldn't do it. As a matter of fact, he also wanted to pull cash out on some of his investment properties as well to buy more investment properties. That's the leverage that you guys find often, that people are using the equity in one property to parlay into another property. That was severely hampered over the last month or so with these restrictions. Now we've opened that back up significantly. Again, we're only keeping it for our top tier clients. And I want to be super clear, this is Summit Funding's rule. So don't tell somebody else, oh, your bank can't do it because John King said you have to have a 700 credit score. More often than not, you're going to find banks are going to be more restrictive than we are in this arena. But you might find somebody that's less restrictive because it is a overlay and it's a bank by bank decision. The second piece that I was super excited about is the issue with rental income. So first and foremost, we still have to confirm that the renter is paying their rents for the current month. We used to require, or kind of our knee-jerk reaction was, we wanted a letter from the tenant that says, hey, I'm not going to ever forbear. Well, not ever, but I have no plans to forbear. And our attorneys quickly said, yeah, that's not really legal to ask the tenant to write that letter. So we stopped doing that. I just want to remind you, in case you were on one of those webinars previously, we don't require the forbearance or the statement from the tenant that they're not going to forbear. But more importantly is we are now once again allowing rents from a departure residence. Departure residence is somebody's owner-occupied property that they are moving out of, and they're buying a new owner-occupied property, but they're keeping that old property as a rental. Last week I did a webinar on that exact topic of how to buy a home when you already own one. And we talked about the 3 scenarios of, hey, do you buy a new home first and sell your old home after? Do you buy and sell at the same time? Or do you sell your current home first and buy the new one after? And this was a big component that if you were keeping your old home, I couldn't, under current guidelines, count any rental income from that current home. Now I can. We have to have a fully executed arm's length rental agreement. Arm's length means it can't be your family member. We have to have the security deposit and first month's rent received in the borrower's account, and it has to coincide with the dollar amounts on the lease agreement and the dates on the lease agreement. We have to have an additional 6 months of reserves, and they have to have a 680 minimum credit score. But that's huge for the average person that simply says, hey, I'm tired of being cooped up in this small home and I want to buy a bigger home. I'd like to be quarantined in something larger, please, Mr. or Mrs. Realtor. This is a huge opportunity for these people to qualify that previously they had to qualify with both monthly payments. And that was hampering a lot of people's ability to buy that larger home or to downsize and keep their other home as a rental. Just remember, occupancy motivation is huge, especially when somebody's downsizing and keeping the other home as a rental property. That is a pretty decent hurdle, because in general, the American way is to live in the best and nicest home you possibly can. And if you live in a bigger home and you're buying something smaller and you're keeping the bigger one, we're going to highly scrutinize your motivation. And it's got to make sense. And it's got to be logical in what is social norms. I've talked about this before, but I just want to remind you of that fact because I've run into it a couple of more times, and I just want to be really clear that is something super, super important. But the good news is we can now count rental income from a departure residence. Quick reminder of overlays that are still in place, and then those of you who are here on Monday that don't want to hear how to sell or how to get your offer accepted in a competitive market, you can go ahead and disappear. So what we are talking about is no bond loans still. The thing I want to remind you about no bond loans is Todd Screama just yesterday had also talked to him, and he said, look, as soon as the investors are willing to give us the same treatment Fannie Mae and Freddie Mac give us, meaning if we do a loan for somebody that is a bond loan, bond is down payment assistance. If we do a loan for them and they file forbearance right away, then we own the loan. Well, at least Fannie Mae and Freddie Mac say, we'll just charge you 5 or 7% of the face value. If they're willing to charge us a set dollar amount, we are willing to immediately start doing down payment assistance loans again. But right now, they are very, very simply saying, no, we are not going to buy the loan at all. And a down payment assistance loan is completely worthless on the open market. And we aren't willing to take that risk. And most other banks aren't willing to take that risk. We're not doing any renovation loans, and we're not doing any escrow holdbacks. So again, these are case-by-case overlays depending upon the institution you are working with. Most banks are following the same things that I'm showing you here. We're not doing any bond loans, again, down payment assistance. We're not doing any renovation loans or escrow holdbacks, and it really has to do with buyers' willingness or homeowners' willingness to let the contractor in their home to do the work during these shelter-in-place times. And if somebody's not willing to let the contractor into the house to do the work, then we're stuck with an unsellable loan, and we're not willing to take that risk. So we've relaxed some of the guidelines that we had previously taken on, but there's still more guidelines that we hope to relax, and it's definitely a positive sign that we're willing to relax the guidelines that I've shared with you so far. All right, guys, I'm going to dive into the meat of the information that I wanted to present this week. So again, if you were here on Monday and you heard this and you want to listen again, stick around. If you are, but if you did listen in on Monday and you don't want to stick around, feel free to go. All right, so we're going to talk about how to write the winning offer. Here's the great news. You all know all of these secrets. I'm not going to tell you anything that you don't know, but this is a reminder that tried and true tactics work, but you forget about them. And so what I'm going to give you is a refresher course on some of the things that I see people able to do successfully that help them get their offers accepted. Anecdotally, I will tell you that I have seen a 3-fold increase in the number of clients reaching out to get pre-approved since May 1st. My average for, let me say this, February, March, and April, I had around 25 to 30 people reaching out saying, hey, I'd like to get pre-approved for a home. Through this morning, I have 68 clients who have reached out, or referrals from real estate agents that have said they want to get pre-qualified for a home. and we're only 2/3 of the way through the month. So I'm on track literally to have 100 pre-approval requests in the month of May. That's unheard of. So huge increase in demand in May. We also got some statistics. I think I might have heard it from Ryan Lundquist, or I stole it from somebody else, saying that this Monday, so what was that, 3 days ago, 2 days ago? I can't count anymore. We had the highest number of pending homes. In other words, and I'm going to use the wrong lingo here, and you guys are going to correct me, but you've got the number of homes that went pending, so accepted offers. Monday was the highest number of accepted offers in the greater Sacramento Central Valley area that we've had all year. So the activity is there. May 1st was a huge increase in the number of listings that were out there. So we're seeing people that are starting to kind of come out from their hibernation and wake up from their long sleep for the last couple of months. And they're saying, hey, I think it's time to start looking to buy a home. I've been sheltered in place. I don't want to stay here. So let's make that move. So let's talk about how we make this work for you. The first thing is, think about it from the seller's perspective. I know a lot of you are great listing agents and you take great care of your sellers, but are you putting yourself in the mindset of the seller when you're working with a buyer writing your offer? Are you paying attention to how you're structuring your offer, making sure that you're being as collaborative as you can be with the agent on the other side, and really putting yourself in the position of how would I feel if I got this offer? Guys, I hear so often from listing agents about the quality of the offer that was written. And I'm literally talking about penmanship if you're doing it by pen, although most of you aren't, but I am talking about, more importantly, how thoroughly you're filling out the RPA. Because that is a huge indicator to the listing agent of your quality if they don't already know you as an agent. And if you're not filling in any of the basic details on the RPA, then they're going to be seriously concerned about your ability to perform through the entire transaction. You have to make sure you're presenting yourself professional and polished, because the listing agent has a lot of influence over the seller when you have multiple offers at a similar price. You've got to be thinking that way. You also have to think about the emotions of the seller. And I think there's 3 different sellers that are out there. You've got the seller that is emotional about the price of their home. And they say, oh my gosh, I painted this thing by hand and it's 32 colors on every single wall, and that makes my house worth $20,000 more than every other home out there. Well, the truth is your house is ugly and nobody wants it. And you know that, but they feel so emotional about that fact that they're going to list their house way above the asking price, or way above what it really should sell for, I should say, way above what the market says it should sell for. And you have to think about that seller and say, well, wait a second, if I've got a seller with that mindset, maybe I shouldn't go into this deal asking for a reduction in purchase price and closing cost credits. Because an emotional seller is also emotional about money. And they're going to say, wait a second, are you seriously telling me that you want me to lower my price and pay for your closing costs? Now, that has nothing to do with the dollars, because the dollars might say that's their best offer. Hey, I'm asking for a $10,000 reduction in price and a $10,000 closing cost credit. I'm only asking for $20,000 off. Your next best offer asked for $40,000 off. Yeah, but at least they weren't asking for closing costs too. Sellers are emotional, and you need to read that and think about how you structure your offer. Sometimes that's a situation where you've got to strategize and come up with a different game plan based upon that seller's position. You've got the seller at the other end of the spectrum that says, I want to list my price super, super low, and I want to, get the best activity and the best interest in the home, and then build the auction effect. So that seller is not emotional. That seller is logical and tactical and is trying to create the best price he possibly can. That gives you some insights into the psyche of the seller. People make decisions 3 ways. They make it with their brain, their heart, and their guts. Anything you can do to help get insight into the other party and how they're going to make decisions is going to get the negotiation tilted a little bit in your favor. So if you can read how they listed the price of the home relative to the rest of the market, and you can say, oh man, this guy's a thinker because he's overthinking it. He's listing it super low, trying to create it. He put it at, $299,999 list price, even though it should be selling for around $360. So he's overthinking things, and that gives you some insight into how you would structure your offer, and the details matter to that person. Versus someone that's emotional, as I said, the third seller is the logical seller, the seller that puts their house, hey, my realtor says this is what it should sell for at 360. I trust my realtor, I'm going to do it. That's the person that makes the decision with their guts. So you can quickly get an indication, not a guarantee, but an indication if somebody's making decisions in their head, in their heart, or in their gut based upon what the list price is compared to what you think the comps show. And that can really impact, if you pay attention, to how you write your offer. The second reminder I've got for you guys is the handwritten letter. And I think that that's hugely important for you to do, especially in today's market. We all know, especially with that emotional seller, that person wants to see somebody take the house that they've built, take the backyard that they've raised their children in, swimming in the pool and swinging on the swings, and know that somebody else is going to get the same pleasure and enjoyment that they did. And that's hugely important to a seller. They might not think it, they might not say it, and it may not win over a better priced offer. But in a competitive market, sometimes the difference in price is this much, and it's the intangibles that make the difference. So writing a letter, including a picture, that might help the seller. Give a little bit of information about the client, comment on things they liked about the home. What is somebody's favorite subject to talk about? Themselves. So if you can talk about something about their home that you liked, you're putting them in a good mood as they're looking at your offer. So that's super, super important. And obviously the logical seller is not going to care. So if it's a bank-owned property or an investor selling an investment property, they could care less in most circumstances with the story, with the emotional side of it. That's where you've got to read your seller and know, hey, is this an investor? Is this a bank? Is this somebody that's bidding, that's listing it super, super low to create the auction effect? All right, this one's kind of a no-brainer. Getting your clients pre-approved early. I have a couple of thoughts there. First of all, just in general, a reminder that it is never too early to talk to a mortgage banker like me. Any mortgage banker, but you really should have them talk to me. I tell people, if you're thinking about buying anytime in the next year, you need to come talk to me, because there might be something that you thought wasn't an issue, and when you apply a year from now, you're going to wish you had some time to fix that issue. So check out your qualifications early. Now, this, as far as getting pre-approved before you go look at homes, you know, the issues we're dealing with right now with COVID-19 have essentially mandated that everybody gets pre-approved before they go see a home. So this isn't as much of an issue as it normally is, but I still included it as a reminder. A, we're not always going to be in an environment that mandates a pre-approval before you go look at a home. But B, sometimes we need to go a step further and get a full loan approval. And that is absolutely an option that we can do for you. So if you're in a position where you've got to write a super short escrow, or you know you're going to be in a highly competitive neighborhood that you've got to, that rarely something comes up, then let's get that offer, that buyer fully approved so that we can close super, super quick. And as a reminder, Summit Funding does not use appraisal management companies. We manage all of our appraisals in-house. So that allows for us to move quickly to get an appraisal done. With a rush fee, I can get an appraisal done in 4 or 5 days. And I have yet to have any issues getting an appraiser into a home. So super good information to have for your sellers, actually for your buyers, and just paying attention to a pre-approval as quickly as you can, and from a quality lender. I think you all agree that on a listing, if you've got an internet lender versus a local quality lender that you know, you're going to give preference to the offer from that local lender, because I've got skin in the game. If I don't deliver on the deal, you're not going to be happy with me anymore, and you're not going to trust me on my next deal. So my reputation's at risk. All right, so here's another thing that I do that helps you make sure that you write the right offer. Going back and saying, oops, it wasn't that. Oops, it was you know, it was supposed to be FHA and it was really conventional that I wrote on the offer letter, on the RPA. So this is what I give to all of my realtors when you send me a pre-approval. I realized on Monday when I presented this that I had a copy back from 2016, but it was so good that I just had to keep the same copy. I've been using this for years, and I find that it's very, very helpful for all of us. So it tells you what type of loan they're approved for, if they're using any down payment assistance, which obviously doesn't exist right now. Escrow period. So I'm giving you my projection of what the shortest escrow is. I've updated this form so that, you know, we definitely, 30 days is kind of the longest, and we can tell you whether, hey, we can do a 21-day or we can do a 14-day for this client. what the occupancy of the home is going to do. Is it is it contingent on the sale of their home or not? So many times that's misunderstood, and the buyer gets into contract and they don't have the contingency properly written. And you all know better than I do the challenges that that creates. And I'm really super clear about seller credits. How much of a seller credit am I giving to somebody, or do they need it? And specifically, is it required to make the deal work, or is it preferred? Because there are clients who say, hey, I don't want to spend that much money. Or maybe we say, hey, there's another scenario here. I can bump up your interest rate and decrease your closing costs, but they don't want to pay the higher interest rate. So they'd rather get a closing cost credit, but it isn't necessary. So that's super important to understand, that there are options, that sometimes somebody doesn't have to have a seller credit, and I'm going to put it in there as a potential. And then obviously what I like the most is this last one. The approval represents what? Does it represent the max they qualify for, the max they're comfortable paying, or the amount that they requested but we can go higher, just ask? And that's hugely important, because there's a big misunderstanding in the mortgage industry that we always issue approval letters for the max somebody qualifies for. Guys, I'd freak out most of your buyers if I showed them how much they could really qualify for. If I sent them numbers, I mean, I had a client yesterday that makes $10,000 a month, and they'd qualify for a $4,500 mortgage payment, but their comfort level was $2,500. And so I'm not writing them a pre-approval letter that says you qualify at $4,500 a month, because that would freak them out. So instead, I write it based upon what they were comfortable paying. If your lender does not give you this clear of information when you get a pre-approval letter, fire them and come to me, or ask them the question. But the truth is, you need to get that information, because if you assume, oh, there's always a little bit of wiggle room, well, what if that isn't true? What if I check the first box that says this is the most they qualify for? Well, then you need to know that, because then you're not going to go show them homes for anything above that, or homes that you think are going to go above that. But what if it's the opposite and it's just the max that they're comfortable paying? Well, then you know, if you found their dream home, but you knew to take it, it was going to take $10,000 higher in purchase price. Hey, Mr. Client, I know you weren't comfortable spending more than what it took to buy a house for blank dollar amount, but this perfect house, we can go a little bit higher. Knowing those details, getting that information from your lender to know whether it was the max they qualify for, the max they're comfortable paying, or simply just what they asked for, but they're okay going higher. That's important information to have. Getting your offer in first, just a reminder, guys, I don't see this almost at all in this market. I see it in the Bay Area some, where you have agents that say, hey, I'm not reviewing offers until, you know, a week from now. The people that I've talked to, the agents that I've talked to, have said in those markets that they send the offer in right away. This is a case-by-case thing. It's strategic, but just a thought. This is an example of what a cover letter might look like, with a picture, with some information about them, including some details about the offer itself. Putting that information right there as a cover page is super, super important to make it clear to the listing agent and to the seller what it is that you are offering. Again, guys, if you have questions about anything or any comments about this, feel free to post in comments. The next thing I want to talk about is, again, nothing new here, but just a lot of reminders. Shorten your contract timeframes. If we have, first of all, here's one of the craziest things, and I brought it up on Monday's call. We have the ability to run a property through the file and determine whether we have an appraisal waiver or not. And I never have anybody call me and say, hey, John, we're about to write an offer on 123 Main Street. Can you plug that one in and run it through for the client? We're offering this price. Will we need an appraisal? Because I can do that before you write the offer. And that way you write the offer with no appraisal contingency, because we already know we have an appraisal waiver through the system. That's huge. It's not waiving the appraisal contingency without really knowing what the house is going to appraise for, which obviously there's strategy and concerns there. This is waiving the appraisal contingency because you truly don't need an appraisal. So that's something to pay attention to, and I definitely am open to running that through and telling you whether or not we need an appraisal on that. The same thing is, we can get appraisals done in 5 days. So if somebody is absolutely needing to get a short appraisal contingency and they're willing to spend more for the appraisal fee, because it's about $150 rush fee on average, then we can get, if you got a 7-day appraisal contingency timeframe, I can make that happen. Now I need cooperation from the escrow officer, because I can't order the appraisal until I issue disclosures. I can't issue disclosures until I have the fees, and I got to get the fees from escrow right away. So it does take a village to get an appraisal back that quickly, but it can be done. So if you need a 7-day appraisal contingency and the buyer is willing to spend the money to make that work, we can make it happen. All right, so super, super important to understand contingency timeframes. We are prioritizing purchases and underwriting, so even though we're busy and we have a lot of refinances, those are going on the back burner before the purchase transaction. So we're getting purchases underwritten in 1 to 2 days still. So if you have something that needs a short escrow, I've got a deal that we wrote the offer on a 14-day escrow because I'd already had the client fully approved in underwriting, and we're gonna get it closed in 14 days. So that can be done. All right, the next thing, submit proof of funds with your initial offer. Again, this goes to making the listing agent's life easy. Don't make them ask you for it. So if you have a client that's putting a sizable down payment, especially like, hey, I want confirmation of that, it shows your buyer's willing to or has the money, but more importantly is it demonstrates that you are organized. And I know I wrote in here, demonstrates to the seller that you're organized and proactive. The truth is you're demonstrating it to the listing agent, and your offer appears stronger than those that didn't provide it. The same thing has to do with the next slide about credit scores. If the buyer has a greater than 700 credit score, I recommend that you present that right away. You tell the listing agent in your cover letter, the buyer's credit score is 812. Now, the next best offer, the similar offer, may have a similar credit score. But if it wasn't provided on the piece of paper, then the listing agent and the seller are left wondering, well, I know this guy has an 812 credit score, and I have no idea what this guy's credit score is. That kind of makes the 812 better than the unknown. Like, it doesn't just kind of, like, it really makes the 812 better than the unknown. And that's where you want to put yourself. Just like the prior slide, when it comes to presenting off proof of funds up front, the fact that you have proof of funds, the other guy has money too, I'm sure, but he didn't provide the proof of funds. And it's the fact that you provided it that makes your offer stronger. Guys, this is no different than when you go on a listing appointment and you get beat out or you beat somebody else out because the seller chooses a listing agent because, oh man, I chose the agent because he lists my property on 42 websites and it gets seen by 152,000 eyeballs every single day. All that is the MLS feed. Like, you put it in the MLS and boom, it goes out to 1 million websites and 150 million people see it every day. But the person that said it is the one that the buyer, the decision maker, says, oh my gosh, you do that? The other guy didn't say that he does it, so maybe he doesn't. Same holds true when it comes to credit score. Same holds true when it comes to proof of funds. By providing the information up front, you are showing that I am this, and it beats out the person that didn't provide the information because they're unknown. All right, set expectations before a house is selected. This one's on the verge of controversial, but I went ahead and included it. Here's the deal. I am not telling you, I am not telling you to write offers sight unseen. I'm not telling you to write offers that the buyer isn't convinced to buy. But the truth is, guys, it's our job to be a salesperson. And I know that some of you are saying, oh my gosh, John, how dare you say the S word? We're in sales. Like, it's our job to help our clients make a buying decision. It is not our job to sell them something they don't want or need. But it's about finding a need and filling the need. And the human psyche sometimes takes extra time to get behind the buying decision. And so if you've got a buyer that is 80% sure it's the right thing, I'm saying maybe you write the offer. Maybe you say, hey, you know what, Mr. Buyer, I feel like this is the right property for you. I feel like if we wait, we're going to lose out because there's a lot of other people looking at the homes. And we have a little bit of wiggle room because we're going to get inspections and we'll be able to investigate the house further. The truth is, Mr. Buyer, you're never going to know everything about the house until we get into contract. So don't you agree this is the right thing to do? And you help them make a buying decision. That's super, super important to walk somebody down that road, not because you're convincing them to do something they don't want to do, but you're helping them get out of their own way. All right. The next thing is highly unusual in this market. When we did the call on Monday, I had 2 agents that said they had done it. I'd love to see any comments from anybody if they have done it that's on this call today. But Presenting the contract in person. Has anybody on this call, post in chat for me, if you've ever, as the buyer's agent, presented the purchase contract in person to the listing agent and the seller? While I'm waiting to see if anybody posts, I'll tell you that when we sold my parents' home, my father passed away in 2007 in the Bay Area, and we sold their house in 2007. What? Oh, 2008. Okay, my wife's telling me I forgot the year. All right, my father passed away in 2008. We sold the house, and as we were selling, the buyer's agent actually came to the house to present the offer. And it was a really cool experience. The buyer was actually in the car at the curb, and when we countered, they literally walked outside, talked to the buyer, brought back in the counter, and we literally hashed it all out right there in person. Now, obviously, with COVID and the shelter in place, that's not realistic or viable in today's market, but maybe it is. Maybe we get a little creative and we call the listing agent and say, hey, I'd really like to explain how my offer is structured. You know, can we do a video call with you and your seller so I can just explain the details of the offer to you? It doesn't hurt to ask, and that's really my point. All right, guys, in this part, what I'm trying to get at when I say understanding the market is a lot of people cap themselves on their purchase price because they say, well, I don't want mortgage insurance, so I got to put 20% down. And the truth is, a good, well-qualified buyer can put 15% down and get similar terms to 20% down. So if somebody's trying to get an offer accepted in a competitive market and they're capped at a certain price, there's ways to decrease their down payment requirements without significantly increasing their costs. We've got obviously super low down payment options as well, but the key for me here was to just point out the fact that don't let down payment be the limiting factor that stops somebody from going a little bit higher in price to get the house that they really wanted. Obviously, this we've talked about a little bit in the fact that our job is a sales job. You have got to lead the client. You've got to help them. And part of that is giving the buyer confidence that, hey, I've got a game plan. I've got a system that I use that helps buyers get their offer accepted. And you pick what your system is. But it's about giving the buyer confidence, because when a buyer trusts you, they're going to listen to you. And each and every one of you listening to this are experts in what you do. You just have to present yourself that way. You have to have the confidence and the conviction to say to your buyer, I've shown you 42 homes. First of all, don't show them 42 homes. But I've shown you 42 homes, and I think this is absolutely the right one, and you should write the offer, and this is the price I think it's going to take for you to get that offer accepted. And your level of trust that they, or the level of trust they have in you, is going to determine whether or not they move forward with that recommendation. Seller carryback, or seller leaseback, whatever you want to call it. Again, depending upon circumstances, that can really help you get an offer accepted. Just remember that mortgage guidelines require that an owner-occupied transaction is occupied by the buyer within 60 days. That's why we say up to 2 months. You can't do a 3-month seller in possession, because we have to have, unless it's a rental, we have to have the buyer on an owner-occupied property moving in within 60 days. Time limits on contracts. So again, write your shorten your time frames. We can close quickly. We've talked about this earlier, so I'm not going to go too deep into this. And the final thing is an escalation clause. Now, I've never used the escalation clause. Let me rephrase that. I've never written a contract because I'm not a realtor. I won't speak out of confidence in the rules here. I've heard some people say that legally they don't think that their brokerage doesn't think that it's a good idea, or that they've heard from attorneys it's not a good idea. I'll tell you that one offer I got accepted over the most recent last weekend, actually got accepted on Sunday. It was exactly this that helped get the offer accepted. They wrote an escalation clause on there, and it worked, and they ended up getting their offer accepted without having to go back and forth. So if you have questions about an escalation clause, don't ask me, ask your broker, but it's just a reminder of another tool you have in your toolbox. Guys, the key that I wanted to cover today is reminding you, if you didn't realize it, the market's back. Like, it is super, super busy. People are coming out of the woodwork. I think we're condensing what normally is a 6-month buying season into the next 2, 3, 4 months. And we're going to see a super, super busy 2, 3, or 4 months of purchase activity that's basically making up for all the time that we missed this spring. So if you need to sharpen your skills, I've given you some good ones. I'll be posting this on YouTube, and it's on my Facebook feed. If you have any questions about this or anything else, give me a holler. The only other thing I want to remind you about is every Thursday I am doing a webinar focused on consumers. Tomorrow's webinar is how to build wealth through purchasing investment properties. I am not going to sell them on buying investment properties. I'm going to talk about the pros and the cons. But if you have anybody or yourself who wants to sharpen up on the mortgage guidelines and also just the general things you need to think about that are pros and cons of owning investment properties, definitely encourage you to sign up and join. It's rsvpwithjohn.com to register. You'll get the link to the Zoom meeting, and I'll see you there at 5:30 tomorrow night. If there are no other questions, I'll give you guys 6 minutes back in your day today. I appreciate you joining me, and I hope you all have an absolutely wonderful day. We'll talk to y'all soon. Bye-bye.
Bye, John. Thank you.
You're welcome. Bye-bye.